Imagine standing on the deck of a ship as massive waves crash over the bow. The sky darkens, the wind howls, and your instinct screams to abandon ship. That's exactly what investing in today's market feels like. If you've checked your portfolio lately, you already know what I'm talking about. We've seen dramatic swings that would make even the most seasoned investors question their strategy. Just this past week, we watched the market plunge deep into the red, then surge over 9% in a single day, only to drop again the very next morning. It's during these stormy markets that even smart investors make critical mistakes that can cost them thousands, sometimes tens of thousands of dollars. I know because I've made these mistakes myself. I've watched my own portfolio drop over $10,000 in just days, from $93,000 down to below $83,000. But here's what separates successful investors from the rest. They know exactly which moves to avoid when everyone else is panicking. In today's video, I'm walking you through the 4 most dangerous mistakes investors make during market crashes like the one we're experiencing right now. These aren't just theoretical concepts. I'll show you real examples, real numbers, and the exact strategies I'm using to protect my wealth while positioning for future gains. By the end of this video, you'll have a clear survival guide for navigating this market volatility, without the costly errors that most investors are making at this very moment. So let's dive in with mistake number 1. Perhaps the most tempting reaction when your portfolio is bleeding red. Mistake number 1. The panic sell trap. Let me tell you about 2 investors with identical portfolios when this market started to crash. The first investor couldn't take it anymore. The constant barrage of negative headlines, the red numbers stacking up day after day, it became too much. I need to get out now before things drop even more, they reasoned. Then I can buy back in when the dust settles. The second investor, despite feeling the same gut-wrenching anxiety, remembered something crucial. This wasn't the first market crash, and it wouldn't be the last. This isn't just a hypothetical scenario. This exact situation played out last Wednesday, a day that perfectly demonstrates why timing the market is practically impossible. Midway through Wednesday, the market was deep in the red. Investors who sold at that point locked in their losses, believing things would get worse. Then, out of nowhere, the market did a complete 180-degree turn. By closing bell, the S&P had surged over 9% in a single day, one of the biggest single-day rallies we've seen. But here's where it gets even more unpredictable. Just one day later, on Thursday, the market plunged back into the red, dropping even more. Anyone who thought they could predict these movements was given a harsh reality check. This is why panic selling creates an impossible challenge. You're forced to make not one perfect decision, but 2. You must time your exit perfectly and time your re-entry perfectly. And as we just saw, the market can completely reverse course in hours, not days or weeks. Remember, when you sell during a crash, you're not avoiding a loss. You're converting a temporary decline into a permanent one. What's crucial to understand is that just because stock prices are declining doesn't mean your businesses are broken. The current market volatility is primarily driven by uncertainty, not because the companies you own suddenly became 30% less valuable overnight. Look at the historical evidence. Whether it was the crash of 2008, the pandemic plunge of 2020, or any other major correction, those who kept buying during downturns instead of selling were eventually rewarded for their patience. So what should you do when everything's crashing? First, take a deep breath. Then remember that sometimes the most powerful action is no action at all. Go for a walk, watch some Seinfeld, or do whatever helps you resist that urge to hit the sell button. But whatever you do, don't make this next critical mistake. Mistake number 2. The portfolio obsession spiral. Picture this. You're checking your investment app for the 10th time today. Each glance brings that familiar twist in your stomach as you see the numbers continue to fall. You close the app, promising yourself you won't look again, until 20 minutes later when you can't resist checking just one more time. This constant portfolio checking is a mistake I'm definitely guilty of making myself. And it's easy to justify. You want to stay informed. You're hoping for a turnaround. You feel like you need to know exactly what's happening at all times. But here's the truth. The time this habit consumes is staggering. What feels like just a quick check can easily add up to 10, 20, or even 30 minutes throughout the day without you realizing it. By the time you've opened Charles Schwab for the 10th time, you've burned valuable time that could have been spent doing literally anything else. More importantly, constantly monitoring your portfolio value doesn't lead to better investment decisions. It actually makes things worse. The more you check, the more likely you are to take some kind of action, or at the very least, have an emotional reaction. And when emotions drive your investing decisions instead of logic and rationality, mistakes happen. Let me share a personal example. My portfolio went from around $93,000 at the beginning of April to settling under $83,000 just days later, a $10,000 drop. Did it sting? Absolutely. But imagine how much worse it would have felt if I was checking the decline 100 different times throughout each day, watching that number tick down in real time. When we look at individual holdings, the picture gets even more dramatic. Over half my portfolio is down double digits in the last month. Lowe's is down significantly, AbbVie has dropped 22%, and Starbucks isn't far behind. But here's the perspective shift that changes everything. Stocks aren't lottery tickets randomly bouncing up and down. They represent ownership in living, breathing businesses. As an owner, you need to focus on the long-term fundamentals and tune out the short-term noise. Think of it this way. If you owned a successful coffee shop in your neighborhood, would you recalculate its total value every hour based on how many customers walked in that day? Of course not. You'd focus on the business's overall health, growth trajectory, and long-term profit potential. Treat your stock investments the same way. My recommendation? Set a schedule for when you'll check your portfolio, maybe once a week or even once a month during particularly volatile times. Then stick to it. Your mental health will thank you, and ironically, your investment returns will likely improve. Now, let's talk about the third critical mistake that becomes particularly tempting during market downturns. Mistake number 3, the everything's on sale fallacy. When the market crashes, dividend investors like us often feel like kids in a candy store. Everything's on sale. Share prices are dropping, which means dividend yields are shooting up. It's a dream scenario. But believe it or not, this is precisely when you should become more selective, not less. This isn't the time to cast a wide net and load up on any cheap stock you see. Instead, it's the moment to hone in on your highest conviction ideas, the stocks you've been waiting to buy at better prices. Here's a powerful filter I use during market downturns. Ask yourself, would I still want to own this business if it wasn't so cheap? If the answer is no, then it's probably not a stock you should prioritize. Let me share a real example from my own portfolio that I've been wrestling with. Take a look at Target. In the last month, it's down almost 20%. Year to date, it's lost about 33% of its value. A full third of its market cap gone in just a few months. The current share price is around $92, which is the lowest I've ever seen Target trade. A couple of years ago, I was considering it at $100 to $110 per share and thought it was a good value then. Now at $92, it seems like an incredible bargain. The valuation metrics are compelling. The PE ratio is almost in single digits, the free cash flow yield is approaching 11%, and the dividend yield has soared to nearly 5%. From every angle, Target looks incredibly cheap. But here's where disciplined investing comes in. Every time I consider Target, I compare it to Visa, my largest individual holding and a business I would love to continue investing in. When I stack them side by side, there's no comparison. Even though Visa isn't nearly as cheap as Target right now, its fundamentals are significantly stronger. If I'm being completely honest with myself, the only reason Target is on my radar is because it's gotten so cheap and its dividend yield has been pushed up so high. This is precisely the trap I'm warning about. The same applies to other stocks I'm currently evaluating. But I keep returning to the idea that I'm better off putting more money into my highest conviction holdings like Visa, or looking at quality companies like Rollins or Zoetis, even if their prices haven't dropped as dramatically. With limited investment funds, focus on quality over bargains. You don't need to buy every stock that's on sale. Concentrate your resources on the companies you have the strongest conviction in. These are the ones that will likely deliver the best long-term results, regardless of short-term price movements. Now for the fourth and final critical mistake, which might be the most dangerous of all in these uncertain times. Mistake number 4, investing your emergency fund. We constantly talk about buying the dip and being aggressive with your contributions during market downturns. While that's generally sound advice, there's a dangerous interpretation that can lead to financial disaster: putting your emergency fund into the market. Let me be crystal clear. Your emergency fund is not extra investable cash. It serves a completely different purpose than your investment portfolio. While your investments are designed for growth, your emergency fund exists purely for protection. It's there for life's unexpected challenges: losing your job, facing a medical emergency, or dealing with a sudden car repair. These surprises tend to happen at the most inconvenient times, often when you least expect them. If you invest your emergency fund and then face a genuine emergency, you might be forced to sell your investments at a loss to cover those expenses. This scenario becomes even more painful during a market crash, when your investments may already be down significantly. One of the worst things you can do to your portfolio is interrupt the compounding process. Your greatest strength as an investor is not needing the money you've invested. That flexibility allows you to hold through downturns and avoid selling at the worst possible moments. To be completely transparent, I currently have a good chunk of money sitting in a high-yield savings account specifically earmarked for emergencies. Has it been tempting to throw that cash into my investment portfolio while prices have been low? Absolutely. But I constantly remind myself that this money serves a different purpose. It's not there for growth, it's there for protection. Having that emergency fund is one of the key factors that helps me sleep well at night. It gives me the confidence to stay invested in the market, knowing I won't need to liquidate my holdings if something unexpected occurs. And speaking of sleeping well at night, I find I sleep much better counting my dividends than counting sheep. We've covered the 4 most dangerous mistakes investors make during market crashes: panic selling when prices are dropping, obsessively checking your portfolio, buying any stock that seems cheap without being selective, investing your emergency fund. By avoiding these critical errors, you'll not only protect your wealth during market downturns, but potentially position yourself for significant gains when the recovery inevitably comes. Remember that market volatility is normal and temporary. The investors who build life-changing wealth aren't the ones who perfectly time market moves. They're the ones who stay disciplined, remain patient, and make rational decisions when everyone else is succumbing to emotion. If you found this guide helpful, hit that like button and subscribe for more strategies on building wealth through dividend investing. Drop a comment below and let me know which of these mistakes you've made in the past. I've made all 4 at some point in my investing journey. Thanks for watching, and I'll see you in the next video.